Hello, I'm David Frazier, aka The Market Monk, and this is our daily Market Monk show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to affect your investment portfolio. Well, today on Wednesday, October 1st, stocks fell sharply here in the United States, with the Dow Jones Industrial Average down 238 points, or 1.4%, while the S&P 500 index fell 1.3%, and the NASDAQ Composite Index was down 1.6%. Excuse me, please. I have a bit of a cough, unfortunately. But anyway, let's move forward. Now, we started out today's show the way that we start out all of our shows, and that is by me telling you that we strive to tell you everything that you need to know, but nothing more. And that's truly what we try to do here via the Market Monk Show and at our company, Frazier and Mayo Research, LLC. We bring you news and comments on economic and geopolitical developments that are likely to affect your portfolio. But we don't talk about other things because that would be a waste of your time. And unfortunately, most financial market websites and financial magazines, newspapers, and financial broadcast shows, they operate in a completely different way. I mean, if you listen to these shows, which I do on a daily basis, as little as possible, and I say that because I listen to them only for one reason, to know what they're telling everyone that's listening to them, and for me to get a good perception of what the perceived news is. But I never watch those shows to get any actual insight, because I have found, after being involved in the financial markets, meaning having invested and speculated in the financial markets for more than 25 years, and working in the investment securities industry for more than 20 years, that the vast majority of information that most financial newspapers, magazines, and broadcast shows report on, what you hear is wrong. It's just wrong. I mean, whatever. It's no point for, I'm not going to try to prove that to you, but I assure you that most of what you hear on these shows and through these other outlets is just not accurate. And I'll give you two examples of what I read at some well-known, very large general news as well as financial market news websites earlier today, as well as what I heard on some very well-known financial broadcast shows. And here are just two examples of what I heard today. One is almost an exact quote, and that is, stocks fall on Ebola concerns. On Ebola concerns. Concerns about this Ebola virus. That's why stocks fell today. Do you really believe that? You really think that's why stocks fell today? Did these people who put this out, did they believe that? Who knows what they believe? I guess they thought it would gather a lot of attention just because it's something that's in the news. That is Ebola. I assure you, after once again investing and speculating in the financial markets for many years, stocks did not fall today because of investors and speculators' concerns about Ebola. Another almost exact quote that I heard today from a trader on the New York Stock Exchange. When I say a trader, a floor trader, a person that doesn't actually, well, he might trade for himself, I don't know, but that trades for his firm's accounts. That's his job. He's a floor trader. He said stocks fell because the Fed is being forced to raise interest rates. That was his reason. That's why stocks fell today. Well, first of all, no one forces the Federal Reserve to raise interest rates. No one is forcing the Fed to raise interest rates. And by the way, no one has any authority over the Fed's decisions regarding interest rates except the Federal Reserve. So it's impossible that someone is forcing the Fed to raise interest rates. Secondly, the Fed's not raising interest rates, and it has not said it's going to raise interest rates. It's told us a couple of weeks ago that it's going to continue to reduce its purchases of U.S. government securities. That is, it's going to provide less stimulus to the financial markets and to the economy by not creating as many loanable funds via creating more money. But the Fed has said nothing about any intentions to raise interest rates anytime soon. So this is just a bunch of nonsense. And that's what you get by listening to these shows and going to these major news outlets' websites. You're rarely going to get succinct, accurate information. And we try to do just the opposite, and I think we do a very good job of it. And I'll give you just one example. In the event that you're watching this video on YouTube and not directly at our internet website, I encourage you to start going to our internet website on a regular basis at www.themarketmonk.com. www.themarketmonk.com. And you'll notice if you do go there that we might update this here in a few days. Good chance I will update this message this coming weekend. But I put a note up on our website, on the home page of our website, on September 19th, only 2 weeks ago, where I said explicitly and exactly, I said the recent trading action in the U.S. stock market indicates that stocks are in danger of pulling back sharply. And you and anyone is able to get that type of information from us on at least a weekly basis is absolutely no charge. And you don't have to give us a credit card. We don't try to extract money out of you. You can get that type of information from us on a regular basis by just simply giving us your name and email address, filling out a form on our website on the home page, and we'll send you our weekly market commentary where we review major economic and financial and geopolitical developments, so you'll have a good understanding of where stocks are likely headed, not in just both in the very near term over the course of a few days and a few weeks, as well as many months out into the future. Okay, enough about that. Now, so why did stocks fall today? Well, I don't know the reason. I don't know exactly. I can't get into every investor's and speculator's head and know exactly why a large number of people got out of stocks today. But I can tell you, based on my experience, stocks settled off today largely because of the following two reasons. First of all, the Institute of Supply Management's Manufacturing Index, it's Purchasing Managers Index for the manufacturing sector of the U.S. economy, fell fairly considerably during September as compared to the prior month. Now, I'm not going to get into all the details, but basically what that index shows us is if it's above 50, it means manufacturing activity is continuing to grow. And it is well above 50. It's around 56 for the month of September. But the direction of that index is also very important. It fell from 56. Excuse me. I'll get the exact details. And it's easy for me to do that because I'm looking at our website right now, and here's some other information we provide on our website. I provide daily charts of major economic indicators, as well as comments regarding those indicators. And let's see, what did we have exactly? We had the ISM Purchasing Managers Index for the manufacturing sector fell to 56.6 during September from 59 during August. And that's a fairly considerable decline. Manufacturing activity still expanding, but it grew at a much slower pace, and that's very, very important. And the reason being is I have found that historically, that once we see a peak in manufacturing activity, along with peaks in numerous other leading economic indicators, which we are seeing signs of that historically, once there's a peak in numerous leading economic indicators, and those indicators pull back, that stock prices have historically trended lower for several months following peaks in those indices. So I'm sure that's one of the reasons that stocks fell off sharply today. I mean, there are portfolio managers, market strategists, and economists, and a lot of mutual funds and money management firms in general that also follow these types of statistics, and traders, professional traders do also. So I'm sure that's a big reason that stocks fell off today, is because of this fairly considerable drop in the Institute of Supply Management's Purchasing Managers Index for the manufacturing sector of the economy. Secondly, the U.S. Department of Commerce reported today that construction spending in the United States declined last month. And it was a very modest decline, but still, my review of construction spending, as well as over 100 other economic indicators every month, suggests to me there's a good chance that construction spending has also peaked in this phase of the economic cycle. And there are other folks, analysts and strategists, money managers that are well aware of that, as well as professional traders. So I'm quite sure those are the real reasons that stocks pulled back considerably today. And if we just look at the trading action in the financial markets over the past few weeks, which I've also commented on in my free weekly market commentaries over the past few weeks. If we just look at the trading action, we have the advanced decline lines been trending lower. That's very, very significant, because historically the advanced decline line has peaked and moved lower before stock prices in general have peaked. It's a good leading indicator for the overall stock market. The advanced decline line, if you're not familiar with it, it's a line that one can draw by computing the difference between the number of stocks that move up in price, subtracting the number of stocks that move down in price on any given day by the number that move up in price. So on a cumulative basis, this advanced decline line, advance in stocks minus decline in stocks, it peaked several weeks ago. The percentage of stocks that have closed above their 200-day moving average, which has also historically been a good leading indicator for stock prices in general, peaked about 6 to 8 weeks ago. So just the trading action in the financial markets has been warning us about some potentially big drops. And I think I'm going to wrap it up there. Other than, let me say this, on a positive note, it looks like stocks have fallen to some on a short-term basis, to some oversold levels, and we might get a modest bounce over the next couple of days in stocks. That wouldn't surprise me, simply because it looks like stocks have fallen to some oversold levels. This is based on price momentum statistics. Now, that's all I have to say for today. But I don't do this every day. But I from time to time, I try to encourage folks that watch our videos on YouTube and not on our website, and that are not familiar with our website, to go to our website. We have a lot of information available there, and the important information, without all the noise and all the nonsense and all the numerous articles about things that don't even matter. If you want to be entertained, don't go to our site. Go to some other site. Keep going to these sites and be entertained. But if you want to know what's going on that's likely to affect the value of your portfolio, I encourage you to go to our website on a regular basis, and that's www.themarketmonk.com. So I thank you for listening, and I'll speak with you again tomorrow.